If you're having trouble with understanding the types of loans and payments for your UBC real estate licensing exam, you've come to the right place. This video is one of 8 videos that we'll be uploading for free to ensure you build a strong foundation for the math portion of your UBC real estate exam prep. Now, all the videos that we'll be uploading to this playlist are from our real estate licensing tutorial course over at excelrealtyacademy.com. So if you find this video helpful, but want a more personalized experience in your journey to becoming a real estate agent in BC, we put a link in the description of this video so you can compare the 3 programs that we offer, which have helped thousands of people go from overwhelmed to fully licensed real estate agents. Now, without further ado, here is the types of loans and payments lesson. Enjoy. Hello and welcome to chapter 13 and 14, part 2. This video is about types of loan repayments. But let's cover our disclaimers. This presentation is copyrighted by Excel Realty Academy. It is to be used only by the students who are currently enrolled in our program. You agree to not record, copy, share this presentation in part or whole, and the content of this tutorial course does not constitute any legal or professional advice. Now let's get into it. So starting with loan types, there are many different types of loans, and this video is focused on covering them. So we're going to start with the interest accruing loan. Sometimes the course will describe this loan as an accruing loan, or use the word accruing alone to describe this type of loan. An interest accruing loan is when someone borrows money and pays both the principal and interest in one lump sum payment at the end. For example, someone borrows $100 and pays back $110 in 1 year. An interest accruing loan is more risky for lenders since they don't get payments over the life of the loan and therefore are typically shorter term loans. So let's say we have a 1-year loan for $100 at 10%. So the rate is 10% per year, the payments are 0, and the length of the loan, the N, is 1 year. Now the present value, which is the amount borrowed, is $100. And the future value, which is what the borrower owes at the end, is $110. Now, another type of loan is called an interest-only loan, sometimes described as an interest loan. This loan is the same as a line of credit, where one borrows money, then makes payments that go towards the interest only. Nothing goes towards the principal during the life of the loan. Therefore, the PV equals the FV. So how does an interest-only loan look? Well, for example, let's say Mike borrows $100 at 10% interest. He gets $100 at the beginning and pays $10 every year. In the 4th year, he pays $10 in interest, and with this last payment, he pays the $100 back. Mike owed the same amount that he borrowed because he was only paying the interest portion of the loan and nothing went towards the principal. Quick pause. Understanding the kinds of repayment schedules can feel a bit abstract. So that's exactly why we have curated a bunch of practice questions and additional study material in our courses at excelrealtyacademy.com to ensure our students ace it. Now back to the video. Now, what about mortgages? As mentioned in the last video, mortgages are unique and can have different payment methods. The first payment method is called the graduated payment mortgage, where the payments get bigger over time. For example, say you graduated from medical school, and now you're doing your residence. Your income is not that big yet, but you expect your income to gradually increase in the near future, and you want to buy a house now. If the bank agrees to advance you a loan, you make smaller payments in the beginning, and as your income gradually increases, your payments will also gradually increase. Next is the straight line principal reduction loan. A straight line principal reduction loan is the opposite, as the payments get smaller over time. Let's say you are close to retirement. So in a few years, your income will go down. So you want to make bigger payments now, and when your income becomes smaller, the payments are also smaller. So, for example, you'll still be able to afford these smaller payments when you get your pension. Next is a variable rate mortgage. In a variable rate mortgage, the payments move with the market rates. If market rates go up, the interest on the loan goes up and the payments increase. If rates go down, the payments go down. You would choose this repayment plan because you expect the rates to go down in the near future. Another is the reverse annuity mortgage. An easy way to remember it is that it is the reverse of a normal loan. So it is the bank that pays the homeowner. This product is usually marketed to seniors. For example, a senior fully owns their property. However, they need extra money, so they approach a lender to collect a few $1,000s a month from the lender. At one point, the principal and the interest are due, and they are repaid by the sale of the property. The most common mortgage repayment plan is called a constant payment mortgage. In the constant mortgage repayment plan, the payments are constant. It's the same dollar amount every month. The payment has two components. The first component goes towards the interest, and the second goes to the principal. In the beginning, very little of the payment goes towards the principal, and most goes towards the interest. But payment after payment, a little more goes towards the principal, and less goes towards the interest. Most of the questions that we will solve are based on the constant payment mortgage. Now, if we were going to draw out these different types of loans, this is how they would look like. Now that's all for this video. Thank you very much for watching, and we'll see you in part 3. If you like this video, you'll love the next one in our playlist. And if you want to take your UBC real estate exam prep to the next level, make sure to click the link in the description and check out our programs. Bye for now.